here. Just to sort of go over what I'm going to be covering here, tax planning is a big area. My goal here is to go over some of the basics and cover some of the most useful items in the tax planning toolkit. I will also address some items in the Biden tax proposals at the end of the presentation. I do apologize if I give short coverage of some things you're interested in, but I only have an hour here and it's a big tax world. Please email me if you have questions about what I cover or about what I don't cover. My name's Joe Christon. I'm a partner in the Des Moines office, and I've been doing this for quite a while. And this is just sort of a distillation of common things that we work with and common tools. I'm going to start with real basic stuff about how estimated taxes work, because there's a lot of thought, a lot of agonizing that goes over these things, and a lot of times it's not cost-effective agonizing. Here are the basic rules for estimated tax. Individuals avoid estimated tax penalties if they pay in either 90% of current year tax or 110% of prior year tax in timely estimated tax payments, withholdings, or any combination of the two of them. If your prior year adjusted gross income is under 150,000, the prior year percentage is 100%, not 110%. Wage withholding is generally credited pro rata over the tax year, and that gives taxpayers who fall behind some room to make up underpaid estimates by increasing withholding later in the year. So that's your first item of the toolkit, building up withholding towards the end of the year to make up for shortfalls. Obviously, the later in the year that it gets, the harder it is to make up. So what is this horrible penalty that we agonize over? It's the IRS quarterly interest rate for the number of days of the underpayment. The rate is currently 3% on an annual basis. So let's see how that works in real life. Here we have a taxpayer who has a $10,000 minimum estimated tax payment requirement. To simplify it, we'll say the taxpayer has no withholding. Taxpayer makes $2,500 in timely estimated tax payments each for the first, second, and third quarter, but forgets to make a fourth quarter payment. And then when the return is due, the taxpayer pays the balance due on April 15th. We'll assume that for this whole period, the IRS interest rate is 3%. The payment is 89 days late, so we take 89 divided by 365 times 0.03 times 2,500, and that gets us a shocking underpayment penalty of $18. Now, the reason I go through this is, so that everybody understands what the underpayment penalty really is a non-deductible interest charge at a rate that's certainly lower than what you're normally going to see on your credit card. So it's not the end of the world if you have some underpayment penalty. Yeah, if you have big numbers, it might be worth planning around, but it's something that you have to watch the cost effectiveness of. $18 is not going to buy a lot of professional time to prevent this penalty. So be sure to consider the cost effectiveness as you try to tie down your estimates. You don't want to spend, $1,000 on professional fees to save $18. C corporations have similar rules, but they're a little stricter. For example, the final installment is due in the 12th month of the tax year, not the first month of the following year. And generally, you have to pay 100%, not 90% of your amount due. Large corporations have a higher penalty rate. Right now, it's 5% as opposed to the 3% for small corps and individuals. Corporations with $1 million or more of taxable income in any of the prior 3 years can only use the prior year tax safe harbor for the first quarter payment. Otherwise, they have to use 90% or 100% of the current year. How do you go about paying your tax? You can use a check, You can use IRS Direct Pay. You can use a debit or credit card. You can use EFTPS, which stands for the Electronic Federal Tax Payment System, or you can have your tax preparer direct debit your tax out of your bank account if you and the tax preparer are both okay with doing that. I'm partial myself to the Electronic Federal Tax Payment System, which can be you can enroll in at EFTPS.gov. Businesses generally have to be enrolled because that's how they pay their payroll taxes. But individuals can also enroll. It's very handy to be able to set up your quarterly payments in advance. And if your situation changes, you can go back and edit your upcoming payments so that they better match your income. It's well worth doing. You sign up on EFTPS.gov. In a couple of weeks, you get a nice letter with a PIN number. You set up your password and you're ready to go. So I feel pretty good about that. What I don't really feel good about is sending checks. Just the other day, I got a client forwarded me a notice saying that the IRS had just processed their fourth quarter 2020 estimated tax payment that they mailed in December. That's a long time between getting the check and processing it. If we'd filed that return without extending it, and fortunately they're on extension, then what would have happened is that we'd have gotten a notice saying that we were underpaid by the amount of that fourth quarter payment that they hadn't processed yet because it was sitting in the bottom of a mail bin somewhere in Fresno or someplace. So watch out for that and consider using electronic means to pay your payments. Okay, now we're going to talk a little bit about the tax planning process. And nobody ever talked about tax planning better than Abe Lincoln when he said in his House Divided speech, if we could first know where we are and whither we are tending, we could then better judge what to do and how to do it. That's why we do projections, to find out where we are and whither we are tending with a taxable income. And then you have to figure out, what is your goal? Are you trying to avoid penalties? Are you having an unusual year and you want to plan out the cash for when you pay your taxes and determine whether you want to pay some of it in the fourth quarter versus waiting for the balance due? Or do you just want to avoid underpayment penalties? There's where you really get into the cost benefit issue again. You know, you don't want to be spending $1,000 on a projection to save $18. But if you are going to owe a six-figure balance due in April and you need to make sure you have the right amount of cash on hand and want to see what you can do for planning, then it's absolutely worth it. So when you're doing these projections, make sure you consider K1s and other 1040 business items. We have clients that have big Schedule C. They run their whole business on their Schedule C. They might have an LLC that feeds into that. You got to consider those items because those are usually the biggest and most variable items on that sort of return. Okay, now we're going to open our toolbox and see what we have here. Go over some of our more well-learned tools for tax planning. And first, we're going to talk about some of the most important ones that I think a lot of people take for granted, and that's tax deferred accounts. Most basic tax advice that you can give almost anybody who has a wage job is maximize your 401k deferrals. Often you have an employer match. If you aren't at least deferring enough to get the full employer match, you're basically voluntarily cutting your own pay, which makes very little sense. I know that, you know, it's hard sometimes when you're just starting out to not get that whole paycheck, but Your 60-year-old self will thank you if you start maximizing your 401k deferral when you are in your 20s. Contribute to a health savings account if you are eligible. These things are great, and we'll talk a little bit about that as we go on. Once you've done that, then if you have some room to save, contribute to an IRA. If you can do a Roth, great. If you can do a deductible one, great. If you can't do either, a straight up non-deductible IRA is not a terrible thing. Also, as soon as you have kids, you might want to start using a Section 529 plan. And we will go through all of these. So what sort of IRA? Well, I've already kind of covered most of the 401k, but we'll talk about IRAs because more usually the 401ks are the employer's issue, and you can't do a lot about it. Okay, traditional IRA are deductible for taxpayers without another retirement plan. They've been around a long time. The deduction phases out for taxpayers who participate or are eligible to participate in another employer retirement plan. But if you can't deduct it, you can make non-deductible contributions up to the annual contribution limits if the deduction is phased out. The non-deductible portion of an IRA contribution comes out tax-free. The phase-out ranges are now up on your screen, and I won't go through all of those in detail, but they aren't super high. Once you get to 66,000 as a single filer or 105,000 on a joint return, those deductions start to phase out. So the deduction there can be limited. So let's say you've had a non-deductible IRA. How does that work? Here we have a taxpayer who's made $60,000 in non-deductible IRA contributions over the lifetime. In the first year of retirement, when the gross balance of the IRA is $200,000, taxpayer withdraws $10,000. Since 30% of the account balance is from non-deductible contributions, then 30% of the withdrawal, or $3,000, is tax-free and the rest is taxable. In recent years, Roth IRA contributions have become popular. Roth IRA contributions are not deductible. However, qualified distributions are tax-free. Non-qualified distributions are taxed similarly to withdrawals from non-deductible traditional IRAs. A qualified distribution is one made after the 5-year period, beginning with the first tax year for which the contribution was made to a Roth IRA set up for your benefit. And the payment or distribution is made on or after the date you hit 59.5, made because of disability, made to a beneficiary or to your estate after your death, or is for a first-time home purchase. Roth IRAs have higher income limits. Joint filers don't start phasing out until they hit 198,000 of adjusted gross income, and single filers don't start phasing out to 125,000. So Roth contributions are very useful as you for a lot bigger range of people than a traditional IRA. But even if you exceed those limits, a lot of people can make Roth IRA contributions by the back door. In other words, you make a non-deductible contribution to a traditional IRA, and then you roll that into a Roth IRA. Some commentators have challenged it. The IRS has not, that we're aware of. However, if you have an existing traditional IRA with earnings, then if you do make one of these backdoor contributions, go back to our traditional IRA withdrawal example, you'll find yourself having to pay some tax on that conversion of that amount. For 2021, the IRA maximum contributions for all types of IRAs are the lesser of your compensation income, which is wages, Schedule C income, et cetera, or $6,000, $7,000 if you are 50 or older by year end. Health savings accounts are often neglected, but they are a great way to build up savings. A lot of people think of them in terms of a flexible spending account where you make a deductible contribution and use it right away to pay medical expenses, and that's fine. That's what it's there for. But you don't have to use it right away for medical expenses. You can later on to make withdrawals if you've kept records for your prior out-of-pocket medical expenses and have them tax-free to that extent. Even if you don't have enough to do qualifying withdrawals, if you don't have enough medical expenses, that's okay, because once you turn 65, you can make non-qualifying withdrawals that are taxed like traditional IRA withdrawals. So you just have to wait till you're 65. So they more or less flip into retirement accounts in effect as you hit Medicare age. So not a bad deal. And you can find some that have, very nice investment options, including, things like index funds. And they can become very efficient tax savings vehicles with an upfront deduction and upfront tax savings. In order to have one of these, you have to have high deductible health insurance. Minimum annual deductible is $1,400 for self-only coverage and $2,800 for family coverage, and the maximum deductibles are up there on your slide. The contribution limits for 2021 for single coverage are $3,600 and $7,200 for family coverage. Again, if you put in money in one of these things when you're young and you just let it build up and you don't take it out for medical coverage, and you have it invested in a nice total market stock index fund, it can really be a nice part of your retirement nest egg. Finally, I'm going to talk briefly about 401k plans, which I've covered very quickly at the beginning of this portion of the show. Just to note that self-employed taxpayers or single employee S corporations may be able to contribute as much as $63,500 to a one-member profit sharing plan if they are 50 or older and if they have sufficient qualifying income. Some caveats: taxpayers participating in more than one plan only get one limit. So if you have a day job with a 401k plan and you have a side gig that's making good money, you only have one run up this maximum contribution ladder. In order to use a 401k plan, it needs to be set up by the end of the year. But funding of amounts other than elective deferrals can be delayed until the return filing date. The other thing is that as a regular profit sharing type plan, a solo K plan requires more compliance, particularly in the way of 5,500 filings. So they have a little bit more compliance cost than certainly an IRA. But, if you can sock away $63,500 tax-free, get a nice deduction up front and put it away until retirement, then it's worth a little bit of compliance cost. Finally, we'll talk about the SEP IRA, the last minute friend of gig workers. These can be set up as late as the return filing deadline, including extensions. They allow a deduction of up to 25% of compensation for contributions to the SEP IRA. For self-employed taxpayers, the formula makes it work out to be more of a 20% contribution. They are very easy to set up with no employer 5,500 requirement. All you have to do is sign an IRS form and stick it in a drawer. Downside is they're inflexible. There's no discrimination allowed among qualifying employees. So again, if you have employees versus just a straight up working by yourself gig job, you probably don't want to do this. If you have a side job and you own another business, you don't want one of these because you're going to have to aggregate them. But more than once, I've had somebody who qualifies for one of these things, take these, have a big balance due and knock it way down by setting up a SEP right before the extended return deadline or the April 15th deadline. So real useful item in the tax toolkit, more of a post-mortem tax planning than an advanced tax planning tool. Now we're going to go into something that a lot of people don't think of when they think of it as tax planning, but it's tax planning, and that is investing for tax efficiency in your taxable accounts. Buy and hold is an excellent tax planning tool. We have some numbers from the Eide Bailey Financial Services people that quantify how high turnover in trading accounts can be very expensive and greatly reduce your after-tax returns. So buy and hold is a good thing. If you buy mutual funds, look for funds that don't make big capital gain distributions. In other words, that's sort of an extension of buy and hold. If they're making big capital gain distributions, that usually means the mutual fund is turning over its portfolio and distributing out the capital gains. And that's not buying and holding. If you sell stock with a gain in a taxable account, look to offset your gains with losses. In other words, if you sell gains out of your TD Ameritrade or Schwab account, and you have losses in that account that you don't recognize by year end, you are voluntarily paying extra capital gain taxes. And that's a strange idea for most of us. You might as well just write a check out to the Bureau of Public Debt, and I can provide you the address for that. But most of us just as soon would pay all of what we owe, but not increase that unnecessarily. Of course, holding long-term for over a year for any shares rewards you with better federal tax rates. Now, as we look at the Biden plan, there might be some modifications for that, at least in the short term, but that's still the general rate. Finally, work with your broker and find out if you can specifically identify lots if you're selling part of your interest in something. You might have high basis and low basis shares of an investment. Better to sell the high basis shares. Okay, you've done all these things and you still have capital gains. Are there any mulligans out there that can help avoid tax? And one of them is qualifying to opportunity zone incentives. If capital gains are reinvested in a qualified opportunity zone through a qualified opportunity fund, taxpayers may defer and partially reduce capital gain recognitions. I won't get into all the details of how these things work. The short term, or the short version is that an opportunity zone investment is a business that's been set up in a census tract that is considered underprivileged or relatively poor, low income, and therefore they have this location-based incentive to set up businesses in there. So in order to do this, you basically have to buy into some sort of business. You only have to reinvest the gain, not the entire proceeds of the sale that triggered the gain. Here are the benefits, and they're elective. If you invest in that qualified opportunity fund within 180 days of the sale or exchange that triggers the gain, you can defer the gain until the earlier of disposition of the investment or December 31st, 2026. So you're going to recognize the gain no later than the 2026 Form 1040, but you can defer it until then. Plus, if you act this year and hold it until that 2026 gain, you can permanently have 10% of that deferred gain forgiven. So that's not a bad deal. And then if you hold on for 10 years any appreciation you have in that investment will be forgiven. So that's not a bad deal. So what's that mean for a 2021 gain deferral? $100,000 gain deferred in a qualified opportunity fund in 2021 would be deferred until 2026 unless you sell the investment sooner. If it's held until the end of the 2026, 90% of the original gain would be taxed on the 2026 return, but 10% of the gain would never be taxed. If you hold on to that investment for 10 years before selling, any additional gain from the investment, in other words, any increase in value from 2021 going forward, would never be taxed. Downside, of course, is that only is useful if the investment actually does appreciate. You get no basis for the amount you defer, so if it goes badly, you're out of luck. Still, an interesting thing, and there are an increasing amount of qualified opportunity funds out there, and there may be some that would be useful if you have a large capital gain that you'd kind of like to not pay tax on right away. Finally, like-kind exchanges. These still work for investment or business real estate, but not anything else. Unless it's a rare direct swap, it requires a qualified escrow or qualified intermediary. In other words, you can't let your hands touch that money before it gets reinvested. It has to go into a qualified escrow or qualified intermediary. It is not a cash rollover provision. You have 45 days to identify replacement property after you sell the initial property and 180 days to close. Those dates are critical. Little foot faults like that will blow your deferral and cause you to recognize all that gain right away. Otherwise, that gain gets, if you're successful at this, your gain is deferred until you sell the property that you get back in the exchange. Another key part of individual planning is charitable gift planning. And the main tool in that part of the toolbox is giving gifts to charity of appreciated long-term gain property. Gifts of those properties done properly are deductible at the full fair market value, and the gain on those properties is never recognized. So two benefits: no gain recognition, full fair market value deduction. Pretty good deal. The easiest way to do these kinds of gifts is with appreciated publicly traded securities, because these can be donated without any appraisal requirement, because you can just Google the price at the date of the gift, and that's your deduction. One tip though, when you do that, if you have a charity that you want to favor with a donation of public securities, please don't wait until the last minute. Small charities, churches, local groups may not be very sophisticated, may need some extra time to set up a brokerage account, to arrange to receive the donation before year end. So don't try to do this on the afternoon of December 31st and feel confident that you're going to get it done. Give the charity and your friendly investment broker some time to get the paperwork done and get everything moved. Now, if you don't donate appreciated securities and you're donating other property, then a qualified appraisal is required to take a deduction. This is true even if the charity immediately sells the property, so you know exactly what it's worth, or even if you have a perfect comparable sale. No appraisal equals zero deduction. That's a bad result. The appraisal has to be timely. It must be made in time to file the return, and it can be made no later than 60 days prior to the donation. The appraiser has to complete Part 4 of the Form 8283 and sign it. The appraisals must be independent and meet requirements specified in Form 8283. So, for example, you generally cannot have the person who sold you what you're donating do the appraisal. That's considered a conflict, and they can't do it. Your appraiser has to be somebody who's in the business of appraising that kind of property. And, you know, it doesn't matter how good the appraisal is, if you have the wrong person do it, it doesn't work. There was a very sad taxpayer who gave a 6-figure donation of real estate. He was a real estate investor in the real estate business, and he put together his own appraisal of it and donated the property. But because it wasn't a qualified appraiser, because he's not independent of himself, he got 0 deduction on exam, and he lost a 6-figure charitable donation. Really bad result. So if you're going to donate non-publicly traded securities to charity, make sure that you get started on the appraisal process and contact your tax advisor as part of the process, so that you don't footfault your way out of the deduction on this. Cash or non-cash, it's very important that you meet the substantiation requirements. All donations $250 and up require written acknowledgement that includes the name of the organization, the amount of a cash contribution, the description but not the value of non-cash contributions, a statement that no goods or services were provided by the organization if that was the case. If there were goods or services provided, a description and good faith estimate of the value of the goods or services that the organization provided. And if they were religious benefits, a statement that the services provided were entirely intangible religious benefits. Again, the rule is that if you do not have substantiation when you file your return, you have a 0 deduction. Well, what if you say, well, that's fine, you know, that's kind of a hassle, and I'm sure that I can get the church or the chamber or whoever I give the donation to get me written substantiation if the IRS comes calling. That's too late. If it's not provided by the time you get your return, it's considered to fail the substantiation test, and you get no deduction. Same with appraisals. If your appraisal doesn't work, if you got a bad appraisal, you can't, or if you don't have one at all, you can't go out and get one after the IRS comes calling. It's too late. You've lost your deduction. Vehicle donations have some special rules. If you donate a qualified vehicle with a claim fair market value of more than $500, you can deduct the smaller of the gross proceeds of the sale of the vehicle by the organization or its value at the time of donation. Again, if that value claimed is over $5,000, you're going to need a timely appraisal. There's one tool I want to mention, though, before I go on to business, and this relates to donations of household goods. There have been a number of tax court cases where there have been household goods donated with claim values of over $5,000 and no appraisal. Common situation would be if you've inherited your parents' or your in-laws' house, or some shirt-tail relative, and you're the last surviving heir, and you go to clean out their house and they've got just a whole bunch of stuff, and you know that it's worth a lot, and so you take it down to Goodwill and you say, this has got to be worth $20,000. Well, unless you have that stuff appraised, you're out of luck, because $20,000 requires an appraisal, and you'll get 0 deduction if you don't have that appraisal done. However, if you have different classes of properties, such as say, for example, a coin collection, china, clothes, furniture, and you divide up your donation into those things, and each of those categories is under $5,000, you can list those out separately and claim each category without a donation. So keep that in mind if you have that situation. Now we're going to move on into some of our business tax reduction toolkits. And first, we're going to talk about the 3 key items to successful business tax planning. And those 3 are records, records, and records. If you don't have good records, it's going to be a nightmare both to get your return done, and then if you get examined, it gets really ugly. If it's worth the time to spend it, even though if you're running a business, you probably don't have a lot of extra time. If you don't have the time or you don't feel like you have the ability to do it, strongly consider outsourcing. Eide Bailly has a business outsourcing solutions division that can help you. And there are, of course, other people that can do that. But of course, I recommend Eide Bailly. Some of the everyday tools that we have are fixed asset acquisitions, beneficial accounting methods, and helpful tax credits. Fixed assets can really be useful if you need them, of course. You don't want to buy business equipment you don't need. But Section 179 lets you deduct instead of depreciate equipment up to $1,050,000, or if less, your business income. 100% bonus depreciation remains available this year. And that, unlike 179, you can generate a loss with bonus depreciation. Though Section 179D deduction for energy efficient building improvements is a great tool. Almost all building codes now require a certain amount of energy efficiency. So if you're doing any commercial construction, there's a very high probability that you'll qualify for this. If so, be sure you contact the Eide Bailly Fixed Asset Service Group. They can help identify those expenses. Or they can do a fixed asset study of your entire property and identify what portions of your building actually can qualify as shorter lived equipment, eligible potentially for bonus depreciation versus being capitalized and deducted over 39 years. Another common tool is to make sure you're using the most beneficial accounting methods available for your business. Taxpayers with average gross receipts under 25 million, adjusted for inflation from 2018, may qualify for a number of beneficial accounting methods, including cash basis, no need to keep Section 263A inventories, and completed contract accounting. So that $25 million number is done on a control group basis. So if you have multiple businesses, you can't split it up into a bunch of ones that are under 25 million in gross receipts. However, it's still a very widely used tool to control your taxable income. Finally, there are a lot of helpful tax credits out there, including research credits and work opportunity tax credits for employing certain underprivileged employee groups. There are also a lot of state credits that can be available for similar type hires. The Eide Bailly tax credit team is really good at doing this, and we can help identify tax credits. A lot of businesses say, well, I don't think that I qualify. I'm not sure I do research. Well, don't be so sure. I know for a fact that a lot of businesses leave these work opportunity tax credits and the associated state benefits on the table by not gathering the proper information when they're hiring. So we can help with that as well. Also keep in mind that with COVID, there are some special one-time breaks. The employee retention credit is a big deal, and it applies to a surprisingly large number of employees and employers, and is very lucrative. So if you have not had taken a hard look at whether you qualify, contact your Eide Bailly specialist and take another look at it. Also remember that qualifying Paycheck Protection Program forgiveness is tax-free, but the expenses are deductible that give rise to that forgiveness. Very useful tool. And then if you have a loss in 2018 through 2020, you get a special carryback rule. The 2017 Tax Cuts and Jobs Act eliminated most net operating loss credits, or most not net operating loss carry forwards. However, the COVID relief legislation restored carrybacks for a 3-year period. You can carry them back up to 5 years, get nice refunds. Might be a really good cash generating tool for you. For those of you who have income from pass-through, or more importantly, losses from pass-through entities, we have 4 hurdles that we have to clear before we can deduct any of those losses. Those hurdles start with basis. What is your basis in the investment? If you have to have enough basis to take the loss. Then if you clear that hurdle, the next one is called the AtRisk Rules. These are an anti-tax shelter rule that was enacted, I believe, in the Ford administration. People don't think about it a lot, and then when they don't, it comes back and bites them. So keep that in mind. The AtRisk Rules basically have to say that, if you've got borrowed money that you've used to generate basis, either borrowing to buy S corporation stock or borrowing inside a partnership, you have to be on the hook for that one way or another. In other words, if the business goes belly up, you're writing the check to the bank. And then if you clear that hurdle, you have the passive loss rules, which we'll talk about in a little bit more detail. Finally, individual business loss limits. That's a new thing for 2021. It was enacted with the 2017 Act, but the due date was delayed because of COVID. Well, it's not delayed any longer, and it's something that you need to be aware of as you do your 2021 tax planning for your business income and loss. It's really important, particularly in the S corporation and somewhat in the partnership context, to monitor your basis to make sure that you have enough to take your losses. Distributions from an S corporation or a partnership reduce basis. So you might want to watch that as you go into year end to ensure that any losses are available. You haven't made enough distributions to eliminate your ability to take losses. The at-risk rules, as I mentioned, target most non-recourse debt. There is a loophole there for third-party debt to use to purchase a real estate investment, but otherwise non-recourse debt is not considered at risk. Here you run into a trap that it's really sneaky, and it's not an obvious trap, but it's out there, and that's when you have related party financing. For example, if you borrow money from a relative to buy S corporation stock, and your relatives control the S corporation, your basis in that will not be at risk because of a rule that was enacted to fight an old style tax shelter where they would borrow inflated amounts from the promoter of the tax shelter to use to buy the tax shelter investment to generate inflated basis. And they said, well, if you borrow from somebody who has a stake in that investment, or if you borrow from the investment itself, it's not going to work. That's not going to be at risk. Those losses get deferred. So anytime you're financing your business with related party financing, make sure you run it by your tax advisor. Make sure that you are going to be at risk, assuming that you need to be at risk for that basis. Okay, we've cleared the basis rules. We've cleared the at-risk hurdle. Now, can we clear the passive loss rule? Passive loss rules were enacted in the 1986 Act to lock down that generation of tax shelters. Passive losses are deductible only to the extent of passive business income. What makes an entity non-passive? Generally, it's a charged hour, or not a charged hour, working hour requirement. If you work 500 hours in the activity, you're non-passive. If you work 500 hours split across multiple 100 plus hour activities, you're non-passive in each of those activities. If you work 100 hours in the activity and more than anybody else, you're a non-passive. If your participation is substantially all the participation in the activity, then you are non-passive. And then there's a general facts and circumstances participation. Well, how is the IRS going to know whether you're participating or not? Well, if you're examined and the IRS questions your participation, it's not on them to prove that you haven't participated. It's on you to prove that you have. So if there's going to be any question about it, if you're not working full-time, if you're a serial entrepreneur with multiple activities, keep a daily calendar and write down how much you're working. It's by far the best way. There's been a lot of litigation since 1986 on this. If you have a good calendar that you keep currently, you win. If you don't, you try to hash together something, your success rate's going to be a lot lower. Also, there's a last 5 years rule for these charged hour things. If you meet any of these hours requirements in 5 of the previous 10 years, then you're considered non-passive. So somebody who retires, but they've worked full-time in the business for a long time, they've got 5 good years of being non-passive. And there's a special rule for retired farmers. Once a farmer starts taking Social Security, retirement, or disability, and they've worked 5 of the 8 years prior to taking retirement or disability, then their retirement is, their participation in the farming activity never dies. They participate as long as they live, and their spouse participates if they outlive the farmer. Finally, here's a new one, business loss limits. And this one's going to be ugly this year for a lot of people. 2017 tax law imposed limits on business losses that clear all these other hurdles when you do an individual return. They were waived, as I mentioned, for 2018 through 2020, but they're back for 2021. The limits are $250,000 for single taxpayers and $500,000 on joint returns adjusted for post-2018 inflation. So those numbers come out to inflation index 262,000 loss max in for single filers and 524,000 for joint filers. Quick example of how it works. Here we have Emma, a single taxpayer, owns an S corporation. She has $500,000 in losses from her S corporation, and she has cleared the basis, at risk, and passive hurdles. She draws a $300,000 salary from the corporation and has $300,000 in other income. Her income before itemized deductions ends up being $338,000 taxable. Start with $300,000 salary, $300,000 other income, $500,000 loss. Then you have to add back the excess income of $238,000, which is $500,000 minus the $262,000 loss cap. That $238,000 excess is not deductible this year. It's treated as a net operating loss carry forward to the next year. And then you have to test it again. So it's going to be an important item. Key thing to keep in mind, why did she have a $500,000 loss? Well, she had $300,000 of salary income, and that increased her loss from the S corporation by $300,000. So that's would have been a bad idea if she had taken a year-end bonus to generate that loss, because she would have basically accelerated income unnecessarily. We're going to talk about a new thing here for businesses that have pass-through income, optional state entity level taxes. Background here, 2017 Tax Cuts and Jobs Act limits the deduction for state and local taxes on Schedule A to $10,000 through 2025. The effect of this is to make taxes paid on income from pass-through businesses non-deductible. A number of states have enacted optional entity level taxes that come with the shareholder credit for entity level taxes paid as a way to avoid the SALT cap. What states have enacted it? You can see them on the slide. I won't read them out to you, but there's quite a few of them, and there's likely to be more. California has just signed one into law, and here's the basics of how it works. Here we're talking about a single owner S corporation, California resident, $100 million of $1 million of California income, 37% marginal individual federal rate. California entity tax is 9.3%. Taxpayer opts into this by the due date of the California return, pays $93,000 at the entity level to California. Instead of having a K1 of $100,000 or of $1 million, the taxpayer gets to reduce his K1 income by the $93,000 paid by the entity to California at the entity level. So the tax on that $907,000 is $335,590. The federal tax would have been $370,000 had the entity level tax not been paid, and had that tax been paid at the individual and level paid instead. Shareholder savings come out to $34,410. So not a bad deal by moving that tax payment up to the entity level. Should you do this? It's not always so simple. If the income is taxed in another state, you're going to want to get a credit on your home state return for the tax paid in another state. Some states, the way it's structured, might not be a problem, but different states have different workaround details. So you'll want to talk to your advisor or the Eide Bailey state and local tax consulting team to figure out how to work with that. If you're a startup business, remember the Section 1202 exclusion, and that's a thing where qualifying original issued stock of a qualified C corporation can be sold with 100% gain exclusion up to $10 million per owner if held up to 5 years, or held at least 5 years. Very useful for a startup that doesn't generate a lot of taxable income, but may be generating a lot of valuable intellectual property or other intangible property. So keep that in mind. I'm going to skip over the 199A since we're running out of time, but we're going to, even though that's important for tax planning, and we're going to talk briefly about estate and gift planning. While on the campaign trail, the Biden administration proposed some pretty substantial changes in estate and gift issues. When they issued their 2021 legislative agenda, they left the lifetime exemption unchanged, the rates unchanged, and specific estate planning tools like valuation discounts untouched. However, the Biden income tax proposals would tax capital gains over $1 million on sale, at death, or if gifted, and eliminate the date of death basis step up. So also keep in mind that the lifetime estate and gift tax exemption will fall back to $1 million in 2026 from the current to $5 million in 2026 from the current $11,700,000. So it's a good time to be using that 11.7 because it's going to automatically go away unless Congress acts, and depending on Congress is a dangerous way to go. If you're fortunate enough to have this as a problem, remember that gift tax is cheaper than estate tax because gift tax is only imposed on the net transfer, while estate tax is imposed on the whole estate, including the amount used to pay the tax. And then finally, the Biden plan has an increase in rates, elimination of capital gain break for high incomes, taxation of capital gains at death over $1 million, increase in corporate rates and limits on like-kind exchanges. That means that some of the tax planning tools that we usually use may not be a good idea under these circumstances. You don't want to defer income to a year in which the rates have gone up. It'll decide whether you really want to accelerate or defer deductions. And you may, if you're going to be selling, if your choice is between selling something this year or next year rather than holding on for a long time, there may be a value to sell this year. What's the current status of the Biden tax plan? It's very uncertain. I think something will happen. I think what will happen will fall short of his agenda, because I don't think that he'll be able to get what he needs in a narrowly divided Congress through. But stay tuned, read the Eide Bailey Tax News and Reviews blog, ebtaxblog.com. And every business day, you'll probably see an update of where that's at. Okay, I've gone through this pretty quickly, and I apologize if I skipped over some things. We can get you the slide deck, and I'd be happy to talk or reply to emails that you might send to me about some of the issues that we've discussed. And you know, right now, remember that a lot of the tax planning tools that we use, typically involving deferral of income, may not be a great idea if we're going to be deferring them into a year in which the rates are going